Hello and welcome to the download. I'm your host, Dave Richardson, and it is Jobs Friday, except it's Thursday. And we'll explain why with Canada's hardest working economist, chief economist at RBC Global Asset Management, Eric Lascelles. Eric, always great to see you. And before we get into the economics, because there is a lot of stuff going on, Blue Jays in first place. And I know baseball is close to your heart. And since basically everything you touch turns to gold,
I was
where
at
were you
the Blue
last night?
Jays game. Now, let the record show, for those who know the Rogers Center in
Oh,
the 500 levels, it was not the most exciting of seats. But nevertheless, so that game, if they had won, they would be in first place. They did win. They are, I guess, tied for first place with the Yankees, who they beat. And we'll see if they can hang on to that in the final game of that series. I gather that's tonight. But I will say this: they were winning 8-0 after the first inning, and it seemed to be done. And so it was, with our hearts did sink somewhat by I think it was the 8th inning, when suddenly it was 8-8 after an Aaron Judge home run. So that was not ideal, but they did pull through in the end. And I think they won 10-8. But anyways, they did win in the end. So how about that?
yes. Well, you were experiencing the thrill of victory. I was experiencing the thrill of the
Oh,
Canadian healthcare system, which just as a start, the people in the Canadian healthcare system, unbelievable. The doctors, nurses, amazing. It's great that we have healthcare. So let's just state that. But it
oh
was
no.
13 hours. And so but everyone's okay, so we'll say that, and we'll move on with everything that is okay in jobland in the US, because tomorrow is July 4th. Friday is normally when the US would release their employment data. So, but they brought it forward a day, which is I think Canada's pushing theirs to next week with our holiday, but in the U.S. they got their report out today, and Eric Lascelles, close observer of all things jobs reports,
These
what does
job
it say?
numbers were not born on the 4th of July, Dave. They were born on July 3rd. There you go. Uh,
Oh,
I saw that movie about 9 times in a row as a 13-year-old. This is a very foolish thing for a 13-year-old to be doing, but we did I was a serious runner once upon a time, and our track club, I think ill-advisedly, participated in a 24-hour relay. And so there were like 8 of us kids running, what is 24 hours at one point, everybody was running. And they had a little tent showing one movie, and I seem to recall it was just that movie over and over again. So in any event, neither here nor there.
oh,
We won. We beat an RCMP team, a Mounties team. So I guess that was the small consolation.
oh, very good.
But the U.S. payrolls, they also beat something. They beat the consensus. So pretty decent looking. So
Wow,
I will temper it. I'll temper it in a
yeah,
moment. There were
decent
a couple
looking.
little
Yep,
holes, but overall, you would say it was a good looking report.
yep.
What do you know? 147,000 jobs created in the U.S. In the month of June. The consensus had been 106,000, so that was a pretty significant beat. We all had, I guess, we were waiting with bated breath, you could say, because yesterday the ADP came out. So the ADP is sort of a private sector equivalent. It was minus
Yes.
33,000. We all thought, is this the moment when job creation vanishes? And so the answer is not at all. There was even, and often these reports in recent months have been undermined by downward revisions that make the number look good, and then it's not so good once you think about all the jobs that actually hadn't been created in earlier months that we had thought had been. That wasn't the case this time, so 16,000 upward revision jobs to the prior 2 months, so that wasn't a problem. The unemployment rate looked good. It was, went from 4.2 down to 4.1. The consensus had been it would do the opposite, go from 4.2 to 4.3. So this is a materially better spot, though, as is often the case when the unemployment rate moves around, there's also some sort of labor force participation rate decline type stuff that muddies it a bit. But still, we're still in a low 4% unemployment rate range, which we have taken to describing as an economy that's pretty close to full employment, which is what you want. And so I would say
Yeah.
the conclusion is a pretty good report. Even the household survey, sometimes that household survey, the other number that gets less attention and just really bounces around, actually pretty similar. It was up 93,000. So looked fine. For the pessimists, for those looking for a cloud around the silver lining, I guess you could say private sector hiring was only 74,000. So it was actually a little bit less than expected. So I think it was the education sector to the rescue and some other things. So corporations aren't going
Hmm.
crazy right now. aggregate weekly hours worked, which tend to swing a bit, were down as opposed to up. So you could say, more workers, less work being done. That is in theory controlling for summer holidays and things like that. So it wasn't a perfect report, but overall I would say looked fine. Very much pushes back against the idea that the U.S. economy is in big trouble. I think you would still maybe say there's a slight deceleration afoot when you look beyond the job numbers, and happy to get into that or not if you like. But I would say
Yeah,
these numbers
yeah.
held up
No,
and would suggest there wasn't a collapse in June.
yeah, yeah, and I think that's an important point, especially given again that ADP report, which comes out
Mm-hmm.
usually the Wednesday, in front of the jobs number, which again usually Friday, but this week Thursday, and it was a very weak number, and a very weak number against much higher expectations. Not just that it was a negative number, which got some people concerned about this job number this morning. And then once again, we see the number come in okay, as you say. It's not spectacular, but good, solid number, with the holes that you'd poke in it, as you just did. But there's a lot going on beneath the surface when we look at the U.S. economy. We've got the beautifully named Big Beautiful Bill, which I actually worked with Big Beautiful Bill several years ago, and he was a very solid coworker. But this is different. This is a massive package, which is working through Congress. It's gone through the Senate. It looks like we're taping this at about 10 a.m. on Thursday, July 3rd. So we're just waiting for news that the House of Representatives in the U.S., of course, the two chambers of Congress, they both have to pass the same bill, and then it goes to the president for signature. The president wants it, again, in keeping with his July 4th holiday. Let's sign. When he signs it into law, then it becomes official government policy and law. And that he wants to do on July 4th, symbolic. And that big, beautiful bill has a whole bunch of stuff in it, along with yesterday. We get a deal on tariffs
Mm-hmm.
with Vietnam. We've got the July 9th deadline for the negotiation of trade deals all around the world. Of course, we had another hiccup in our own trade war or trade battle or negotiation with the U.S. just this past week. So that will tee up Eric now for a
Yeah.
25-minute
Gee.
run of without taking a breath. Change your podcast speed to half speed. Eric, how do you pull all this together in a way that investors can think about this with respect to their portfolio and where the economy actually goes from here?
I
Interest rates,
sometimes
etc.
listen to a French news podcast to work on my French skills at three-quarters speed, half speed. I'm not sure what that means. That's not a good thing if I'm talking that fast. Gee, you've certainly teed me up, though. Was I supposed to be keeping notes? There were about 9 things in there. You'll have to refresh me on a couple of them, I guess. So let's start with
Yeah,
that budget
yeah,
bill. So as you say, it is looking as though it may actually pull off
yeah,
this July 4th deadline. I think we had thought possibly it could slip further, and really the only thing that ultimately mattered was it got done before sometime in August when the debt ceiling in theory would be hit. So I guess a bonus if it happens earlier as opposed to later. There is a lot going on in there. It remains to be seen exactly, I guess it is being sorted exactly how the House and the Senate are reconciling the slight differences in the two packages that they've both proposed, but there are obviously some pretty massive common themes here. And so one would be tax cuts. And as much as a lot of the tax cuts are just extending existing tax cuts, so there's no real economic boost from that, it's more avoiding an economic drag. But there are some real tax cut bits to it as well. And, tip income is tax exempt,
yeah,
and
yeah, yeah,
overtime, I guess, is treated preferentially, and some other things like that. There are other elements, just focusing, I guess, on the pro-growth side of things. There are elements that encourage, capital expenditures back to sort of the 100% depreciation, which is a pretty big deal as well. There is more spending in certain domains, and so military spending and border security spending spending, I guess, most prominently. Controversially, on the other hand, some of this is paid for via spending cuts elsewhere, and so Medicaid and food stamps are both getting trimmed to some extent, and so obviously fairly controversial, not areas that normally get touched with much regularity, and so that's in the mix as well. On the net, it looks as though this is being scored at increasing the U.S. deficit cumulatively over the next decade by I think a little over $3 trillion is the current sort of estimate that exists, and so fiscal hat would be bigger deficit and debt, and that's its own discussion, and steeper yield curve and term premiums and long-term yields don't get to fall as much as we'd otherwise like, and so on. Economist hat though is, hey, government spending is government spending, or tax cuts are tax cuts, and so this is something of a boost to growth, and it does seem set to enhance 2026 growth. So most of this is of relevance to next year and beyond. It's expiring tax cuts would have expired at the end of this year, and so now they don't, and so that's I guess a 2026 benefit. And so the U.S. economy should move more quickly than otherwise on the basis of this budget bill. Maybe two other budget thoughts that I can think of at least, and so one would be of relevance to Canadian and other international investors. It looks as though that Section 899 did get removed somewhere along the way, unless I've missed a beat here. And so we'd all been a bit nervous that there could be this withholding tax that would effectively increase the tax rate on investments into the U.S. That looks not to be the case, and so I guess that's a win, or avoiding a loss in any event. And then maybe the other thought, just to step back for a moment, unless you've got other budget bill thoughts, Dave, is just we've been, when we think about the Trump agenda, post-election, the story was, okay, there's some things that are growth negative, and so tariffs are growth negative, and less immigration is growth negative. There are things that are growth positive, and so tax cuts would be one, deregulation would be another, extra animal spirits would be a third one, and we were sort of trying to weigh how these would come in, and initially we thought maybe the tailwinds would outmuscle the headwinds, and then for a moment it looked like the headwinds were going to massively outweigh the tailwinds when those tariffs were the only thing that anybody could think about, and we're back to a slightly more balanced place here where tariffs are still here and they are set to hurt, and we'll talk about that I'm sure in a moment, and I wouldn't want to underestimate that, and I even do think that could still be the dominant theme and creating a net slight drag, but I think it's worth again stepping back and saying, okay, but let's not forget there are some tax cuts here, and there is some deregulation that is happening and that is coming, and I was very stubborn in insisting there would still be a positive animal spirits effect, and stock market's not far from all-time highs, and so there is an animal spirits effect, it would appear. So there are some, again, tailwinds that go along with those headwinds, I guess, is the takeaway, and we're being reminded of that recently, and I think that's partially why markets are feeling pretty good again.
So for the folks who are listening who have gray hair like me, they may remember that this smacks in some ways of Reaganomics, in the military spending, the idea, and we touched on this last week, but I wanted to go a little bit deeper on it, or the last time you were here, the idea of the Laffer curve, which is the idea that actually by reducing tax rates, and particularly tax rates on the wealthy, you get the trickle down economics, which end up and fewer people in a sense try to avoid taxes. You stimulate economic growth, and contrary or counterintuitively, that you actually lower taxes yet raise government revenue to address the deficit and debt that you have. And we know that the U.S. has a significant debt problem. In fact, for those of us again who are older and who need income, perhaps from the bond market, or we're concerned about rising prices during our retirement and inflation, that this can, the deficit and the debt getting under control. That's the big risk out there for both stock and bond markets. So where do you fall on the old on the Laffer curve, and the idea that when you actually cut taxes, you can raise tax revenue? Is there any evidence
I
that
mean,
shows that
I think in
historically?
certain niche cases, yes. I'd be surprised if this was one of those cases. So don't get me wrong. I mean, tax cuts, we are budgeting
Yeah.
for more economic growth from them. It's a fiscal stimulus, so I
Yes.
wouldn't want to quibble with that side. You're certainly right in saying that any kind of decision to deliver fiscal stimulus does need to be weighed against the potential fiscal risks and the cost of servicing debt and those sorts of things. And you might mount a slight criticism that that's probably not being done to the extent it might, just given how big the deficit is going into this, though equally the U.S. does have that special privilege of being able to borrow a whole heck of a lot before anyone really complains, as much as that's becoming maybe a bit less profound recently. The Laffer curve, the idea that tax revenue actually rises, I mean, it's certainly true if you go from 100% tax where no one's incented to work to 99% tax, well, for sure. I mean, you can't collect no tax at 100
Yeah.
since no one's going to do anything, and you would at 99. So there are points on the curve, you could say, where that's certainly true. I would say if you're going from a pretty high tax rate to a somewhat less high tax rate, you could maybe squint your eyes and say maybe. I'm not sure the U.S. is quite there right now. I would say they're going from kind of a moderate rate to a
Yeah.
lower rate, and so for sure economic benefits, and of course benefits to those who enjoy the lower tax rate. I'm not sure if the government actually is going to make more net revenue. Now, when we talk about revenue, though, it is worth mentioning. I mentioned, maybe unfairly, that this big beautiful budget bill will potentially increase the U.S. deficit cumulatively by over $3 trillion over the next decade, which is a lot of money even for the U.S. Do note, though, that tariff revenue, and it depends where it lands and all sorts of uncertainties there, but tariff revenue plausibly could be not that different than that. We had initially been thinking that it would fall
Yeah.
somewhat short of sort of matching that increase in costs, and it may not be that much short. And so that is a roundabout way of saying if you were to factor in all these Trump policies in a broader context, maybe the deficit doesn't end up a whole lot bigger over the next decade, though it does still leave the fact that the deficit's pretty big right now and the debt load's pretty big right now, and any kind of conventional approach
Yeah.
would have been to do some fiscal trimming as opposed to the opposite at this kind of juncture.
Yeah, and we should mention that back in the during the Reagan administration, which again hard to believe because
Yeah.
I remember the Reagan administration it began 44 years ago, but the I believe the top marginal tax rate, so the top tax tier in the
Yeah, it was a
U.S. was
lot
at
higher.
70%, and they took it from 70% down to around 28, I believe, 28, 29%. We're not
No.
talking about that kind of a decrease here. You're not at the 70% range, and again, the Laffer curve relies on extremely high tax rates that people go out of their way to avoid. So
Yeah.
you're right. May not be the that may not work the way that
Quite the same.
that you'd that
I may
it
be,
worked
not
back
to
then.
go off on this tangent too far, I may be speaking slightly out of turn here, but my recollection was in the era when the tax rates were really pretty extraordinarily high, like 70% type numbers. I think the UK had like a 95% at some point, which is, I think you'll hear referenced in a
Yes,
Beatles
yes.
song, if I'm not mistaken. The bottom line is that there
Yeah,
were also a fair number of exemptions that exist. You could kind of twist your way around them to avoid them, and so as the tax rate fell, they got rid of some of those exemptions in a way that also
yeah.
meant that it made for a more efficient tax system where you weren't having to call your accountant every second day, I guess. But it maybe wasn't quite the magic of more tax revenue was also related to that.
Yes, and so one of the things we're covering a lot here today. I recognize that. For those of you who haven't been on one of Eric's appearances, what Eric does such a spectacular job of doing, why we love him so much, is that he can break down these complex things that are going on in the global economy into terms that all of us can understand. Hi, Mom, I know you're listening. And so it really allows you to take what's going on in the news and you'll hear different interpretations in the news. And obviously this is one interpretation as well, but it comes from a very clinical economic perspective. What Eric's role is to analyze the global economy and then bring it to the investment managers that he works with to give them to lay out from an economic perspective what's happening in the economies that they're buying and selling stocks, buying and selling bonds, working with currency. So it's what Eric has to produce is analysis that helps make good investment decisions. So if he can do that and explain that to all of us in terms that we can understand, we can take those ideas and make better investment decisions as well. And that's what we're doing. So we're handling a lot here because there's a lot on the table, as there often is with the current president. And so let's get to the final thing that has really been the top of the news. So this bill comes through. It's got some things in there that we've just discussed, but ultimately the tariffs are still kicking around in the background. And that's dominating the discussion around interest rates. It's dominating the discussion around inflation. It's dominating the discussion around employment, and how businesses are making decisions around their employment. So where do we sit with the tariffs right now? We got a couple of deals. We got this deadline.
No, that's exactly
What are
right.
your
So,
thoughts?
we're sitting at, I would say, middling level of tariffs. That's, by the way, a meaningless word, middling, just because, of course, normally there's almost none, and so there's nothing ordinary about anything. It's sort of hard to say what's high,
Yeah.
what's low, what's medium when they're all high compared to what we're used to. But I would say, in the context of possible outcomes, it's sort of a middling, medium level of tariffs right now. But as you say, there is this potential inflection point that's sitting not far in front of us. So July 9th is in theory when the reciprocal tariffs that were greatly reduced in early April are set to represent themselves, unless the White House opts to do something else. And so no one quite knows. And of course, there's always this debate of what's a bluff and what's a negotiating strategy and what is just going to be outright policy. And so I guess there's a couple things to say there. I mean, one would be we've generally had the view that, the U.S. probably does not want all those tariffs to rise, and it's just painful for the U.S. as well. And so likely we won't see that. That would be a worst case scenario. So probably not that. It's possible just the can gets kicked down the road and everybody gets 3 more months, and it was just logistically difficult to negotiate 100 plus trade deals all in the span of 90 days. So could be that. I'm inclined to think it may instead, and I guess we're seeing this play out a little bit. It may actually be sort of three buckets of countries to some extent. You've got a bucket that strike deals, and we've seen the UK strike a deal, and I know Canada's hopeful, though the timeline they've set is a bit longer than July 9th, and there are murmurs that other regions might be in a position, and Vietnam just struck a deal, which we'll get to in a moment. I think a lot of countries, maybe the bulk of countries, I would guess, are just going to get an extension, and if they're negotiating in good faith, that's what the White House has suggested they can expect to get, and so maybe they get until September to sort this all out, and so I think a lot of countries are that. And then we've generally thought, and I would say with less conviction, but we generally thought, and you might get just some countries do get hit, and they either haven't been negotiating with with much enthusiasm, or they are the countries that have the biggest trade surpluses with the U.S. and so on, and so some countries probably will see their tariff rates go up, and so that's been kind of our reasonably neat and tidy assumptions, without really feeling all that confident about our ability to put countries into one bucket or the other, but just it probably plays out a bit like that. I will say it's gotten just proving that any kind of neat and tidy theory will never be precisely right. So Vietnam, as I think you mentioned earlier, did just strike a deal with the U.S., and so you're tempted to say, hey, they're in bucket A, they're in the bucket that managed to negotiate a deal, which I guess technically is
Yeah.
true. However, we'd sort of been thinking that they stood a high chance of being in bucket C, which is the bucket that would see higher tariffs, and in a sense, they are in both buckets at the same time. I'm not sure if this is like a Heisenberg's uncertainty principle thing, or I don't understand particle physics or something
Yeah.
like
Yeah.
that,
Yeah.
but
Yeah.
they struck a deal, but the deal involves higher tariffs than they were paying before they got a deal, which is kind of weird when you think about it. So they were paying that baseline 10% rate that most countries are paying in the world right now, and their deal is that they will pay a 20% rate on almost everything, and then I guess a 40% rate on things that are essentially deemed to be transshipped from China, and kind of trying to work around China's own tariffs. And so I don't know, yeah, both a good news and a bad news story in there. But I guess maybe the point is we've kind of the view that for the countries that have huge trade surpluses with the U.S., and so we're talking really, East Asia, Southeast Asia, obviously China's in the mix,
Yeah.
Vietnam's in the mix, you might say Thailand and Taiwan, and who am I forgetting? South Korea and some others.
Yes.
Gee, I mean, it's not unreasonable to think even if they strike a deal, that tariff rate is more likely to be up than down. And so, in fact, if anything, we're getting a bit of a flavor here. And so maybe the countries with the big trade surpluses get a Vietnam-like deal where their 10% becomes 20%. Countries, maybe more developed countries in general, that maybe don't have quite the same mismatch of competitiveness and so on, maybe get a deal a bit more like the UK. And so the UK deal was keeping that baseline 10% rate, but with some carve outs for certain critical sectors and with quota limitations and with some promises that you wouldn't incorporate China too deeply into your supply chain. And so again, we now have sort of two examples, and I would say that those are probably both pretty decent looking frameworks here. And so without a ton of precision as to what July 9th looks like, I think over time we're going to see countries probably drift into one of those two sort of buckets. And I guess for the Canadian viewers out there, Canada is a bit of a funny case just because, of course, it's A, so trade oriented toward the US, B, isn't paying the baseline 10% rate, so not obviously tracking precisely either of those two paths right now. It'd look grim, as I think you alluded to for a moment, for Canada, where a big threat was being made just about a week ago, and Canada backed down on its digital services tax. And we always thought Canada would. It wasn't clear it would be exactly this way, but we always figured that was probably gone for one reason or another. And so it is gone, and that likely will appease the U.S. to some extent. The U.S. did then immediately pivot and say we don't like the supply management either. So I wouldn't say we're sort of through the difficult negotiation time. But at the end of the day, Canada suggested they think they can get to a deal within, at the time, 30 days, which I believe maps out to July 21st or thereabouts. And so I suspect maybe Canada gets an extension and then working towards a deal. It's pretty clear that in terms of back channels and the Canadian government talking with key sector leaders within Canada, those sector leaders have been asked, what tariff rate could you survive with? So it does seem as though there's some resignation that probably tariffs are not completely going away here for Canada. And so there's likely a deal, but the deal will include some tariffs, probably not too high. And Canada's only paying an average 6% rate right now anyhow. So maybe not totally dissimilar to that has been our working assumption. Canada made the digital services tax concession. We will see on the supply management. It's awfully hard to read on that. And there was recent legislation you might have seen that actually banned Canada from making that concession. So I'm not a legislative expert. I'm not quite sure how you can navigate that, but in any event, that complicates things. And then conversely, probably making some military concessions or at least military commitments. And so not just that NATO commitment that NATO countries are making, which is where they're going to spend 5% of GDP on the military, which is a big number, having spent 1.5% or so in recent years. Really, it's 3.5% on military and 1.5% on infrastructure. And so it's not quite as big a leap as it looks, but it's a big leap. And then, the real question is, does Canada commit maybe to more U.S. procurement specifically, maybe the rest of those F-35s or something like that? Does Canada also commit, as has been rumored, to the U.S. Golden Dome, which would be a North American missile defense system? And you would think that could incorporate bases or at least installations in northern Canada, since I gather missile threats largely come over the Arctic from the other side of the world. So it does sound as though a deal might be forthcoming, but equally probably not a miracle deal for Canada that avoids concessions.
Yeah, and Vietnam is an interesting one. The similarity with Canada is that a significant portion of the economy in Vietnam is driven by goods that go to the U.S. market, similar to Canada, but it's a key in the supply chain and sort of the shifting the supply chain away from now what is more expensive in theory manufacturing in China to some less expensive regions in Southeast Asia. Vietnam's been a big beneficiary of that. I think the test on this, though, and what's interesting as we tie it back, I just want to tie it quickly back to the U.S. economy, and then we'll come back to Canada in a second. But the idea that thus far, even with these tariffs out there, we haven't seen that translate into inflation. So again on the president's side of the argument, it's like, hey, these tariffs are there. We're not seeing any inflation. Cut interest rates. The job market is good, but we said it's not good. It's okay. So we could cut rates here, which is important because the U.S. cutting rates helps us here in Canada as well. But they're why take a country like Vietnam, 20% tariff, could have been 50, could have been much higher. Lots of the economy dependent on coming to the U.S. Some evidence that some of these countries thus far are eating the tariffs, or was this what we were talking about 3 months ago, this inventory buildup? So people brought a bunch of goods in before the tariffs all hit, and now those are the things that are selling in stores, which the retailer doesn't have to raise the price in theory because it's old inventory, but now the new inventory with the higher tariffs is going to come over, and now we're going to have to raise the price. How do you see this all
Right.
coming together with this Vietnam example
Right. Yeah, no,
right in
that's
front of
exactly
us?
right. And so there are a number of ways that the tariff effect can go. And so it can be the foreign producer who eats it. It can be the exchange rate. It can be, wholesalers, retailers,
Yeah,
eating it via lower profit margin, or it can be the consumer eating it. And of course, in practice, it tends to be some mix of those parties.
some
Famously during the first Trump term, it was disproportionately the U.S. consumer that ended up eating that. So that's not a bad assumption for this time. I haven't seen a ton of evidence of foreign producers absorbing all that much, and so what we're actually tracking is U.S. import prices. And so this is very head scratching, or makes my head hurt to think about. But if we were seeing U.S. import prices fall, that would be a sign of the tariffs, and of the tariffs kind of pushing price declines back to the foreign producer. The tariff gets leveled after the import price, if that makes sense. So bottom line is,
the import
so we
price.
really haven't
Yes.
seen too much there, I would say. Like certainly not import prices falling in any profound way. So I would say not too much there. The exchange rate, of course, not at all. The U.S. dollar's weaker, not stronger. That the stronger part would have been the absorbing
Not
the
yes.
tariff effect. So it's if anything, there's more to absorb, unfortunately, in terms of this currency effect on top of the tariff effect, and it's not trivial, right? I mean, it's a 10% drop in the currency. You can argue that's almost as profound as the tariff effect. So that's kind of an extra amount to absorb. Equally, we haven't seen it in the consumer that much, and so that kind of leaves for the moment two interpretations. And so one is what you presented, and I think it's very much true, which is there was some front loading and inventories were built, and we've seen and hedging I'm sure occurred and so on, and we've seen companies so far manage to avoid raising prices without themselves feeling pain either. So I think that's a fair chunk of it, and so that would be a but there's more pain later kind of story, and I think that's a big chunk of it. And then the other question, which we really haven't answered yet, and I guess so far we're not seeing too much of this, but it would just be whether we're actually seeing profit margins diminish, and is it the American companies that are absorbing some of it? And it's not an absurd proposition. I mean, we've seen explicit pressure even from the White House on some big retailers. You better not raise your prices, and so I don't doubt there is some. I will say we're surprised it's taking this long for higher prices to show up. So highly fallible ourselves. So I'm not the final authority or voice of God on this subject by any means. I will still say we are expecting some increase in prices coming down the pipe, and so I can say that from a theoretical standpoint, that's how it worked last time. It's usually how a lot of this works out when you look at the sort of products differentiated and so on. It makes sense. I can say that and I'm not a corporate level analyst, but we have a lot of really smart people who do that here. And so from what I'm hearing from them, the bigger retailers, be it the Walmart, Amazon, Costco types, are suggesting they will be passing higher prices through, notably in July, August, September. I think is sort of the time frame they've talked about, sort of gradually but substantially. And so that would suggest we may see more coming. And then the other one is, and this is imprecise as well, but we look at some of this alternative daily inflation type data, and it's not exploding or anything, but when we look at products that are associated with China and this sort of thing, and furniture and electronics and recreational goods and so on, the prices are definitely rising more quickly than we're used to. So we are assuming we get something, but I do want to put this into context, which is even if we get the full bore effect that we've been assuming, and so far we haven't, let the record show, even if we're getting that, we're talking about another percentage point on the level of prices, and so not to diminish that, but it's 3.5% inflation
Yeah.
for a year instead of 2.5% is kind of what we're saying. And we did live through 8-9% inflation a couple of years ago, and none of us want to go back to that, but it's not the same, I guess is the point.
Yeah, let's go to that because and just again baseline. What I'm hoping this does, and why we're digging into this, because it's so important, because you're going to have members of the Trump administration on TV, and they're going to be talking about this economic agenda, and what they're looking for, and then you're going to hear people from the Fed, and you're going to hear others who are going to say, well, if you do this, this can happen, and we need to fight the deficit, and all how it all comes together as you're watching the news in whatever way you consume it. So just want to give you some tools through Eric to be able to, okay, all right, well that's spin, that's me, okay, here's what I need to watch here, here's how I can interpret that statement, because we really are, as we go through the second half of the year, with markets at all-time highs, with interest rates low, but the longer term interest rates have not come down as much as you might have expected. Once you start to cut rates and the economy slows a little bit as it did in the first half of the year. How do you piece all this together and make decisions around investments? So we wanted to lay that groundwork. But the one of the things that we've also got to point out is you talk about currency, because people miss currency. People don't watch. I think Canadians watch the Canadian dollar, U.S. dollar conversion rate, but they don't often think about the U.S. dollar versus the euro and things of that nature. But if we look at the U.S. dollar against a basket of currencies so far this year, it is down nearly 12%. Now, if you look at the previous the Trump administration, that was in the midst of what you would say one of the more powerful long-term bull markets or upward market in the value of the U.S. dollar. And again, as you say, that is one of the ways you can absorb some of these tariffs. Instead of having that as a positive effect, this time it's going to be a negative effect. So these are some of the things we have to keep watching, and we'll keep you abreast with Eric coming on every couple of weeks. So Eric, just one last question then. So we've got a pro-growth agenda. We've got interest rates that are likely not going to rise. They at some point we see them falling. Canada hopefully is going to get through the worst of any tariff scare. We're already seeing the Canadian market, so particularly again in Canadian dollars, which is the way most Canadians invest in Canada, and then they invest in the U.S. They've got to bring their dollars back into Canadian dollars. We've seen the Canadian dollar appreciate almost 10% from its bottom in February. The markets seem to be sensing that things might get a little bit better on the economic front here in Canada. As we piece all of this together, most of this kind of looks on a relative level anyways, like it's going to be good news.
Yeah,
for
I think there's some truth to that. That's right. I mean, the tariff blow is not as bad as feared. If anything, we're a bit surprised by the extent to which the Canadian economy has shown tariff-associated damage on that basis. And so I'm holding myself back until I see evidence to this to say there should be an acceleration to unwind the overreaction that maybe predated it. I certainly wouldn't want to underestimate the very real damage being suffered by three sectors of the economy that are facing tariffs right now, and the potential for more. Yes. So it is tough to say, but at a minimum, we're very much in the camp that thinks there doesn't have to be a recession. I think we're slight optimists relative to the consensus in the market in that regard right now, without expecting great success in the next couple of quarters. We are seeing government policy changes. Tax cuts are in now for Canada, and there is a real effort, it seems, to get infrastructure investment and resource investment and military spending and some other things going. And not to suggest the government is the central driver of any kind of economy, but it's a contributor. And so I guess as we look into 2026 and beyond, at least we are feeling better about Canada. We think that there's a reasonably good story there.
Excellent. Well, that's a terrific way to end it. Just so listeners know, teed up a bunch of podcasts over the next 2-3 weeks where we're going to be checking in with investment managers from all over the world to check out what's going on in their markets, their outlook for the second half of the year and into 2026. We're starting to get, again, a little bit more clarity around what's going to go on with the budget in the U.S. We're starting to see how Canada's reacting to that in terms of from a policy perspective. We're getting a little bit more clarity on tariffs, although I imagine there's going to be a cloud around that for a while. But from an investment perspective, you're going to want to tune in because we're going to have people in markets all around the world operating virtually everywhere, emerging markets, Europe, Asia, everywhere, giving their thoughts on what happened in the first half and what they think is going to happen in the second half. A lot of these folks rely on the guidance and wisdom of Eric Lascelles. Eric, always great. We covered arguably way too much ground, so we'll try and do less the next time. Less, maybe more. But thanks for coming on today. I know how busy you are, and
for sure, my pleasure. Happy summer, everybody.
This recording has been provided by RBC Global Asset Management, Inc. for informational purposes only and is not intended to be investment or financial advice. You should consult your own legal, accounting, tax, investment, or financial planning advisors before engaging in any transactions.